Okay, I am recording this now. All right, so go through the formalities here. Everything we're doing today is for educational purposes only, and we are not giving any actual trade advice. So what we'll be showing you is what myself and Becky, how we approach trading the markets and how we go, what type of strategies we use, and how we utilize them to make money consistently over the years. But we're not promoting, say, buy this or buy that, but we're showing you the strategies and how we use it, how we apply it. And if you have an interest in that type of approach, then ask more questions. But we'll detail how we approach trading the markets. And it's for educational purposes only and not actual financial advice. All right, today we're going to go over a bearish strategy, call it a bear attack. And what we have here is just a sample trading plan. But we're going to be focusing on the charts, and then we'll refer back to the trading plan. But the main thing is on the charts. So before we actually get into things, is there anyone who does not understand a candlestick chart or a candlestick, basic candlestick? Then I can go over that first. Just either unmute and say something or type it in, and I will go over that if needed. Because you need to be able to just at least know open, high, low, and close, price on a chart. And we use candlesticks. So does anyone not understand how to read a candlestick? Okay. I saw a question about seeing the documents. Is that okay now? Have you able to find the documents to download? Should be on that link. Let's click on it real quick just to make sure. Yep, link is working. That's it. That is in the chat window. That's a working link. And on that page, just to show you real quick, I will actually switch to that page so everyone sees it. You share. See, if you go to that website, that's my behind scenes website, you'll see the handouts right here and some other previous recordings, listing of previous trades going back several years, and also a video recording of another future strategy, a bullish one, and something you may want to take a look at. We listed on one chart 1 year worth of trades. This was on the NASDAQ. This was using options, but 1 year's worth of trades up and down, all of them on just one symbol, and we trade 28 ETFs, but this was the NASDAQ, and it was 41 trades with 3 losses. So we maintain a pretty high win percentage, especially with options, but this is a good chart to just see how the trades come up and how they're utilized. All right, so this is what it looks like for that website. And now I'm going to go back to the charts. And if there's any questions along the way, okay, I understand candlesticks. Okay, does anyone not understand candlesticks? So I think Michael said, I understand candlesticks. And if you don't see the document, it's on the page. You have to scroll down and go to the page, scroll down on it, and find the link. Like, here's a PDF. Okay, good, Michael. So it should be seeing the page right now for the handouts. Go to that website page that's in the, and the first link is the PDF of the handout. All right, and if you still have trouble, I can email them to you later on. Just email me later if you, for some reason, you can't see the files. If you're looking at this on, let's see, it depends. It might be, yeah, you should be able to see it on any instrument, including phone. So it should be visible. All right, I'm going to go back to the chart now, and we'll work on the chart for a while and make sure you understand this strategy. All right, so on the charts now, everyone says they understand basic candlesticks. Okay, when you see on the chart here, you're going to see red and green candles. It doesn't matter if it's an up day or down day. Some of these candles are colored red because of the indicator being used to color them red or green. So it doesn't matter if it's an up day or down day. If the candle is filled in, it's a down day. If it's not filled in, it's an up day. The open bodies is an up day. The filled in candles are down days, right? So this strategy we call bear attack. And it's a bearish strategy which we use on currencies. We used it on Forex. Some of you have traded Forex with me know about the bear attack strategy, and it's the same, pretty much the same strategy we're using on currency futures. With the futures, we trade Australian dollar, British pound, euro, Swiss franc, and Canadian dollar. Those are the 5 currencies which we trade with futures. And we chose those because those particular currencies also have micro futures, which we can trade. They have the full size contracts in addition to the micro futures. All right, so I'm going to go over, let's switch back and go to my brokerage account and show you the futures there, what those look like. Okay, so this is my account on Schwab, and these are all the different types of futures that are available to trade. Okay, today we're looking at currency futures. All right, so Australian dollar, British pound, Canadian dollar, we trade. These are the full-size contracts. And for the micro contract, which is 1/10 the size of the regular contract, you'll find an M in front of the symbol. So instead of 6A for Australian dollar, it'd be M6A, M meaning micro. So for the euro, if we were trading the full-size euro contract, 1 point well, they go half a tick here. So let's go take a look at the micro. 1 tick is 0.0001. So if we see the price increase by 1 tick from 0.0001 to 0.0002, it meant it went up in value by $1.25. So each tick increment is worth $1.25 on the micro euro. We're going to be looking at the euro this afternoon. All right. We could be looking at Australian dollar, British pound, Canadian dollar, Swiss franc, and there's one other one we do, British pound, Swiss franc, and one more. All right, so we're going to be focusing on the euro for this afternoon. So make a note, because I'm going to be asking you to do some calculations. So someone please bring out a calculator, and we will be using a calculator. I'm going to be asking you for a number, keeping in mind 1 tick is $1.25. So every time you see, if the number move from 0.0001 to 0.0010, that's 10 ticks. That's 10 times $1.25. Okay, so that's $12.50. So keep that in mind. And for every time we use 1 contract of the micro euro, it ties up margin. So if I'm looking at how much margin gets occupied, currency futures, if I got 1 full-size euro contract, it would tie up $1,500 something in margin for 1 contract. If we do a micro contract, the micro euro contract, it's going to tie up $317 in margin. Okay, so for people trading smaller accounts, it's trading with the micros is perfect, because you can place all the same trades as with a bigger size contract, but with a smaller account. 1/10 the risk, 1/10 everything is just smaller. So and we have enough volume to make it very tradable. So that's why I really like trading the micros. We didn't really have the micros available to us for a while, and I got margined out of the futures markets because I swing trade, so everything is bigger on a daily chart. but they brought the micros back several years ago, and boom, I'm back to trading futures, swing trading, all the indices, the NASDAQ, S&P with the ES and the NQYM, the Russell, and all of the currency futures, because we now have the micros available to us at 1/10 the margin and everything of the bigger size contracts, but still all the benefits. So for most of us who don't have a $250,000 to $500,000 account, which is most people, we can now still trade with a much smaller account and be very effective. All right. Along the way, please stop me. You can unmute, ask questions at any time, any point in time whatsoever. If you raise your hand, I will not see it. So unmute, ask a question, or type it into the chat window and I will eventually see it. All right. So we're going to be focusing on the euro for this afternoon. But all the other currencies work exactly the same way, whether you're trading a full size or micro, the analysis is exactly the same. It's just a matter of how big your account is, whether you trade with micros or you trade with a full size contract, right? Since we have different people in the room with different experience levels, I'm going to try to keep it at a level where everyone can understand and follow along. When I work with people one-on-one, then we get into more detail. All right, so I'm going to change the share now back to the chart. And we're going to look at an example. Here is a chart of the euro over the last couple of months. We're going to look at this trade right here, which is the same one that's in the handout, and we're going to go through it in detail with or put numbers to it. So I want you to understand how we actually make money, and how we establish the risk, how we enter a trade, how we exit a trade, how much dollars are made, and the percentage returns, okay? Like I said, any questions you have, just interrupt me, unmute, ask, or type it in. So I want to make sure you're following along, because I know we have some new people in here. All right, what you see on the chart at the bottom is the squeeze indicator. This dotted line is an upper Bollinger Band. I'm only showing a Bollinger Band is 3 lines. I'm only showing the upper one because that's the only one being used. I don't want anything on the chart that's not being used to take up space and just create more noise and on the chart. Since I'm not using 3 lines, I'm just using 1. I'm only showing 1. The dotted line is upper Bollinger Band. These 2 lines are trigger lines. It's a linear regression line and a moving average of the linear regression. When this line crosses above this one, that's a bullish cross, and this is plot 1. When plot 1 crosses below, so this one is plot 1, the bottom line is plot 2. When plot 1 crosses below plot 2, we're in a bearish cross. So now this is plot 1. In a bullish cross, this is plot 1. In a bearish cross, this is plot 1. Okay, so and plot 1 is the moving average. Plot 2 is a linear regression line, okay? And this is the moving average of the linear regression line. You'll see this in many of our strategies with different settings. We don't just use one setting for everything, okay? So different settings for different strategies. If anyone's ever told you one thing works for everything, it's not true. And no one will probably ever tell you that. One thing does not work for everything. So the currency futures do not move the same way the index futures move. The euro does not move the same way the British pound moves, okay? So everything has its own personality and the way it moves. So what we have spent literally thousands of hours trading these live. And so what you're seeing is many hours worth of knowledge gained from both live trading and learning from many people all around this country and from elsewhere too. Myself and Becky would travel around the country and learn from people trading futures, trading options, trading stocks, trading commodities, all different methods, every method you can possibly think of. We have experienced, tried it, and this is a culmination applying many of the things we learned into what you see now. So it's a combination of price and time. So everything you see not just involves price, but time also becomes a factor. Things have to happen by a certain time, or else it's not going right. So time is always a factor. Learn that from doing Gann analysis. And if you incorporate time in addition to price, your results get so much better, just so much better, right? So what we're looking for here, this is a bearish trade, and we're looking for 2 lines to cross bearish. So we're looking for plot 1 to cross below plot 2. Visually, that's all we're looking for. So if this was the day, if this was today, and we look at our charts, plot 1 did not cross below plot 2. It actually crossed up. Plot 1 crossed above plot 2, so we got no bearish setup. The next day, plot 1 is above plot 2, so we got nothing to look at. We don't have any valid setup. The next day, plot 1 is still above plot 2. We got nothing. There's no valid trade setup here. The next day, plot 1 looks like it might be crossing below plot 2. So what I do, since I can't tell with my eyes just looking at this, that plot 1 actually go below, I look at the chart, at the data box on the left side. I look at the data box. The value of plot 1 is still higher than the value of plot 2. Okay, so if plot 1 has not crossed below plot 2 yet, I can't see totally with my eyes, so look at it at the numbers, and plot 1 on the data box is higher than plot 2. I go one more day. Hey, plot 1 crossed below plot 2. Okay, now I have a trade setup. If you look to the trading plan, now I'm going to switch back to the trading plan. Let's see, where am I? Here it is. Okay, here's a trading plan. Everything on our trading plan is done with a setup, trigger, and trade management. Terminology learned from Jake Bernstein. The setup is visually what you're looking for. That's all it is. You're looking for 2 lines crossing. That's visually what you're looking for. You don't have to do a whole lot of analysis to look for 2 lines crossing. The work's been done for you. Those who have come before you have put in the time, effort to come up with all this stuff. And now we're finding ways to utilize knowledge. We're finding ways to utilize knowledge gained before us. And you're finding ways to utilize knowledge from me, which was also incorporates knowledge gained before me. So there's a very cleaned up version of what I've learned, because I like it really simple. I don't want to spend hours every day on a computer doing analysis, looking at charts. I don't want to do any of that stuff. Okay. So our setup is what we look for, and that's a bearish crossing the trigger lines. That was just plot 1 crossing below plot 2. Now we're going to look for the trigger, which is the candle has to be red. And we do use the squeeze and Bollinger Band as a confirmation, but I'm not going into that detail now. I'll say that for coaching sessions because there's more stuff to qualify the trades. And then we'll go to trade management. Okay, so I'm going to go back to the chart now. All right, so what do we see here now? Plot 1 crossed below plot 2. Let's assume this is all we see that day. What I know from our analysis, and we maintain statistics on all these valid trades dating back to 2003. What we know that whenever we get this valid trade setup and we place an order and it gets filled and we follow a very specific trade management, we know that 80 to 89% of the time of those trades, we will have a profitable trade. And when I say profitable, I mean a minimum 40 to 50% return at our first profit objective. If I'm risking $1,000 on a trade, that means I'm going to make between $400 and $500 when the price reaches our first profit objective. If it goes the other way, I'm going to lose $1,000. If it goes my way, the first target where I take profit, the overall position will be up $400 or $500, okay? And we maintain well over 80% winning trades. The rest is just purely math, all right? In this particular case, I'm gonna go for a 50% first profit target, all right? So I'm looking for 50% return on my money at the first target. All right. That is when I take profit. Do we have any questions so far? On anything, any way, shape, or form before I get into the analysis and details? Feel free to unmute. Is that when's the profit target? I'm gonna get into that in a minute or two. All right. So what you see here now, I have the cross. Now, to establish risk, I need to know how big my stop loss is. Okay. And so number one, my stop loss is going to be 10 ticks above the high of the previous day. How Michael said, how about losing $500 instead of $1,000? If you trade size, how much you risk will be determined by how many contracts you get. And I'll go over that also. So the dollar amount you risk is directly proportional to how many contracts you get. So if by buying 4 contracts that total $1,000 risk, if you only wanted to risk $500, then you'd be only getting 2 contracts. If you only wanted to risk $250, you'll be getting 1 contract. So the number of contracts you get will determine your risk. We have to calculate what the risk is on 1 contract, and that's going to be a minimum risk no matter what. And then depending on what the risk on 1 contract is, then we determine what your total risk will be depending on how many contracts you want to trade. So what we're going to do now is determine the risk on 1 contract. So first thing is, someone make a note of this because you're going to be doing the calculations. If you want, by the way, if you want to risk $50,000 in 1 trade, that's okay. If you want to risk $10,000 in 1 trade, that's okay. If you want to risk $1,500 on 1 trade, that's okay. It all depends how big your account is. The actual trade and execution is all the same. It just depends how much you risk is dependent on size of your account. That's it. All right, and we'll detail that a little bit more too. Okay, 10 ticks above the previous day's high. The previous day's high is 1.10835. Someone write that down. High is 1.10835. And we're only looking at 4 decimal places. We're only dealing with 4 decimal places. So if you want to make it 1.1083, that's perfect. 1.1083. What is 10 ticks above 1.1083? Someone type it in. 10 ticks above that is what value? 4 decimal places only. What's 10 ticks above 1.1083? The high is shown in the data box. Someone type it in, then we can move on. 1.1093, perfect. Okay, so that's 10 ticks above. So that is going to be where we place our stop loss, 10 ticks above the high of the previous day. This is not only documented in the detailed trading plan that I give to people I'm coaching, but this is trade management is what we spend most of our time with when I'm coaching, okay? It might be, you might have seen like 1 or 2 sentences in the trade management on a trading plan on the written part. You don't learn to trade this by writing stuff on a plan. You learn to trade this by having someone teach it to you, show you how to manage it. That's how you learn to trade with the trade management. The technical stuff, the criteria that I can put on paper. Learning to trade, you have to have someone show you. You can't document it. It won't make any sense, okay? So 10 ticks above, so now I have my stop loss. My entry price is going to be 15 ticks below the low of the signal day. This is the day I got my trade signal. And the low that day is 1.0928. What is 15 ticks below 1.0928? See the low in the data box. 15 ticks below 1.0928. What is that number? 15 ticks below 1.0928. Someone type it in, please. Okay, 1.0913. Okay, so now, hey, Van. So now we know our entry price and we know our stop loss. Now we have to calculate the risk on one contract. How many ticks is it? What's the difference between the entry price and the stop loss? So if we got into the trade at 1.0913 and
sorry to stop you. What
yeah,
was the entry definition? 50% of what?
the entry price is going to be 15 ticks under the low of the signal day. So the low of the signal day was 1.0928. So 15 ticks below that.
Thank you.
1.0913. All right. So 1.0913 is the entry price. In most trading situations, we get short a market by using a sell stop. So a sell stop, if my entry price is here, I will not get into this trade unless the market goes below that price. So I have to have a market actually going down for my order to get filled with a sell stop. If it was a long trade, I'm looking for the market to go up, then the market actually has to go above a certain price, the buy stop price, to get filled. So in this case, we're using a sell stop to enter the trade. And the sell stop is 1.0913. So unless the market goes below that price, this order will not get filled. Okay. So now risk. If we get filled at 1.0913 and it goes totally against us and gets stopped out, then we need to know what that risk is on one contract. So what is the difference between 1.1093, which is the entry price, and 1.1013, which is the stop loss? So you see in the chat window, what's the difference between the entry and the stop loss? How many ticks is that? Someone type it in. How many tick difference is there between the entry and the stop loss price? I see a lot of numbers that are way off. What is 1.1093 minus 1.0913? Can't be 26, it can't be 27. Is there a point in there? So how many ticks? Gordon, you ought to know the answer. Exactly how many ticks is it? 180. Okay. So 180, thank you. So it would be, if the difference is 0.0180, that's 180 ticks. So 0.0180 would be 180 ticks. All right. So now we know how big how many ticks our stop loss is. And with that size stop loss, that is the size stop loss. And with the target we're using of 50%, that gives us over 80% winning trades. Okay. So now we know how big the target is. I mean, the stop loss is. Remember what one tick was worth on the euro? It was $1.25 per tick. Each tick on the euro, the micro euro contract, is $1.25 per tick. So if each tick is $1.25, and the total number of ticks in the stop loss is 180. What is the dollar amount you are risking on one contract if you get stopped out? 235. Okay, so now we know if we know what our risk is if we take a loss on one contract. It's $235. Let's say we want to risk $1,000 on a trade, approximately. It'll never be exact. It'll never be exactly $1,000. But let's say we wanted to risk $1,000 on a trade. How many contracts can we get? There you go, 4. And that's right around $1,000. Never be exact, but if you're risking $1,000 a trade, you get, now you know you're risking $235 for each contract, and you get a total of 4 contracts, and be right around your max risk. It might be over $100 something, it might be under $100 something, but right around 1,000. So that is how we determine our risk on a trade. And you can see how with a smaller size account, you can trade the currencies real nicely. And with a bigger size account, you can either trade the micro or the full size. So there's something for everyone here. So here's our minimum risk. So now that we established that, what do we do? There's no sitting in front of a computer looking at charts. We see this after 2 p.m. Pacific time is when we see this happen. This candle will be available after 2 p.m. Pacific. This is end of day data. There's nothing moving here. This is not a live chart. We can use our live charts when we're placing the trades. We don't use our live charts for any analysis whatsoever. It's end of day only, okay? So when we place the order, now we need to know what how big our first target is. Our first target is going to be 50% of the stop loss. So if our stop loss was 180 ticks, how many ticks is our first profit target? If the total stop, there you go, 90 ticks. So our stop loss is 180 ticks. Our first profit objective is going to be a 50% return on our risk capital, okay? So if our first target is hit, we're going to make 50% return on our money at the first target. You have a choice of taking your money and run with a 50% return, or you can choose to manage the position and try to trail stop, so on and so forth, to capture more profits. It depends on your account, personality, time available, so on and so forth, what you choose to do. And I'm going to go through a spreadsheet a little bit later on to give you a feel for what to expect profit-wise, loss-wise, what current markets look like for this year. All right. But so far, any questions? I'm trying to make it real clear so you understand how money is made, how money is lost, and how to go through this one strategy. Because how we do this one strategy, we trade a grouping of strategies, maybe 10 plus strategies as a group, for long trades and short trade. You can't find every short trade in one strategy. You can't find every long trade on one strategy. So we trade market tops, we trade market bottoms, and we trade all in between along the way. So different strategies will find different potential trades at different points in the market trend. This one is basically market tops, is what this one does. Okay, so now what we're going to be doing, and so can someone give me a price on a chart for where our stop loss will be if our entry is if our entry price is, the entry price again is 1.10913, it's going to be 1.0913. What is 90 ticks below that? If entry is 1.0913, what is 90 ticks below that? 90 ticks less than 1.0913. What is that number? Okay, 1.0823. Good. So we know our entry price. We know our first target is 1.0823, and we know our stop loss is 10 ticks above the high. We now know more than 90% of traders out there. We also know our risk on the trade. We know we have entry, we know our exit, we have our stop loss, and we know we can calculate our risk and control our risk. At 80 to 90% winning trades, we control our risk. We can, and when we take trades in an ideal world, you're not risking more than 2% of your account on one trade. If you find some people have smaller accounts, it's going to happen where you do end up risking more than 2%. But once you get to a certain point in your trading, you do not want to risk more than 2% of the account on one trade. If everything goes all wrong, you take a full loss, you cannot get hurt by it because you're only risking 2%. If everything went horribly wrong, you lose 2% of the account. At 80-something% wins, you need 2 to 3 wins to offset one loss. And that's just at the first target only. You can make that back up like that. It's not a big deal. You place the next couple of trades, you make your money back, okay? So as long as you're consistent with your trading, you make the money back fairly quickly. So it's not a big deal at all. That's why you don't risk 10, 20, 30, 40% of your account. If one trade goes bad and you lose 20 to 30% of your account, it means you don't really know what you're doing. I'll say that straight up. You don't know what you're doing. You don't understand risk management and taking losses. You can't take losses where you wipe out huge percentages of your account. Been there, done that, learned the hard way again. And then probably learned the hard way a third time. And then, okay, I have learned and I'm not doing that again. 2% account risk per trade. You cannot wipe out huge amounts of your account and expect to make it back. All right, you follow a plan. It's a business. It's not just, this isn't the type of trading where I'm gonna gamble my money. It's gonna be all in all. If you're a gambler, you don't need to do this. Good luck, and to you. This is business. This is trading with an expected annual type returns. If you follow these rules, you hand these rules to 20 people to review, they're going to come back and tell you the same results. It's like, yes, this makes money. And you can go and back test this for years and years and years, and you'll find, yeah, it consistently makes money as long as you're consistent trading. If you go rogue and do some random stuff, then you don't know what to expect. But if you stay on plan, risk no more than 2% of your account, you control the losses. The wins take care of themselves at 80-something% wins. And with each of those 80-something, so it means 8 out of 10 to 9 out of 10 trades are winners, which means you are making 40 to 50% return on 8 out to 9 out of 10 trades, and other 1 or 2 trades out of the 10, you take a full loss. Big deal, as long as you keep the risk the same on every trade. And I'll show you a spreadsheet of that in a little bit. All right, so how we place this order. We do a 1 triggers 2. We're going to place an order for a sell stop. And the sell stop will say, when the euro drops below my entry price, get me into the trade. So let's say we're doing 4 contracts. We're going to get in with 4 contracts, get out and exit the whole position at the first target. So I'm going to place an order that says sell, stop. Sell on a stop order, not stop limit, stop market. Sell on a stop order, 4 contracts when when the euro goes below 1.0913. The moment and that order has to be filled with sometime within the next 2 days. When you place this order, it's after the close, it's after 2 p.m. Pacific time. Then you walk away. There's nothing to do. You're going to place an order that says sell on a stop, 4 contracts when the euro gets below 1.0913. Once that order is filled, it will automatically trigger 2 other orders, which is a 1 cancels other OCO order. 1/2 of the OCO will be the stop loss, which is 10 ticks above the previous day's high, 1.1093, and the second half of that OCO order will be the target, which is 1.0823. So when you place your whole order, there's nothing else for you to do. You place the order and you go live your life. So sometime after 2 p.m. Pacific, you see this trade set up. Oh yeah, we got to cross down. Okay, let me evaluate it. Okay, plan looks good. I went through all my checklists. The stats look 80-something% wins. Okay, good. Everything looks perfect. I place my order. I go to the gym. I go see the kids. If you have children, family, you got things, events to go to, great. You got a little break from work to do your trading. You take the 10, 15, 20 minutes, you do your evaluation, you got to go back to work, go back to work. You got to cook dinner, you cook your dinner, you do whatever you got to do. There's nothing for you to do in front of the computer. You place your trade and you go live your life. Okay. This is part of the evolution of the trader. When we all start out day trading because we think we're supposed to do that, but that's basically what everyone does. But as time goes on, like any other business, you want to work less and be paid more. That is what this swing trading is. Myself and Becky's evolution from day trading to swing trading was the realization that we can sit in front of the computer for 2, 3, 4 hours every morning and get the exact same financial results as spending 15 to 30 minutes a day swing trading after the markets close. The end result, profit or loss, ends up being the same, except it's so much easier to swing trade than to sit there in real time, trying to make decisions in real time. That's ridiculous. And realistically, we all have jobs, we all have things to do. We can't be sitting in front of a computer looking at this when we have other things going on. And I've had people who've called me for coaching with horror stories of being up in the middle of the night doing this, falling asleep in the middle of the night while they're on their computers. When they wake up, the money's gone because the market moved against them. They didn't have the stop losses and they're trying to do stuff in real time. A lot of people can't make decisions in real time doing this stuff, logical decisions. They make emotional decisions. There's no emotion here. This is cold, emotionless, mechanical, place your order, follow the plan, make money. All right. Okay, so now, before I fast forward, do we have any questions so far on anything I've gone over? I want to go over this scenario and then just take a look at the charts and see how money is made a little bit more. Any questions at all?
Thank you. Everything was clear, except that these plot 1 and plot 2, how they are defined. Where should we get them? How should we get them?
These are trigger lines. For people I'm working with, I will give you the indicators. I will give you everything to use. This platform is NinjaTrader. NinjaTrader is free to use for everyone. So I will give you everything you need for this. Plot 2 is a linear regression line, and plot 1 is a moving average of that. You will not find the moving average on most platforms. It has to be programmed. You will find the linear regression curve or linear regression line on most trading platforms. The moving average, something that has to be programmed. So if you know how to program it on your particular brokerage or analysis platform, great. Otherwise, I'll give you the trigger lines for NinjaTrader, and I'll also give it to you for Thinkorswim, because I have it for Thinkorswim. Someone programmed it for me to use in Thinkorswim. I didn't program it, but someone did it for me. So I've got it available for Thinkorswim also. And for each strategy, it's a different setting. So it's not just one settings for everything, different settings for different strategies. All right, but I will make these available. But this is just a linear regression line available on pretty much any analysis platform. And there's a moving average of the plot 2. But you can find plot 2 any place. Plot 1 is the moving average that has to be programmed. All right, does that answer your question?
Yes, thank you. And how can we be a part of the program?
When you say part of the program, what do you mean?
Because you said if you are part of the program, we will give it to you.
Okay, yeah, I'll talk about that a little bit later on. For people who I'm coaching, I make all these available. You don't have to do anything. I pretty much pre-set up all the charts and hand them to you. I hand everything to you. The indicators, the charts, everything is handed to you. And in our first meeting, My job is to make sure all of your charts are set up correctly on Thinkorswim and NinjaTrader, and we work together to get it all set up just right. Basically, I have it, the workspace pre-set up to just hand to you, and we're good to go right away. So you don't have a whole lot to do, but do what I tell you to do, just to make little minor adjustments.
A couple of more questions.
Yeah.
So do you have it also available for Sierra charts?
No, if you want to do it on another platform, you have to program it.
So you give the material so we can program.
I give you the trigger lines from NinjaTrader. If you want to take from NinjaTrader and program it somewhere else, it's up to you. But you're going to have to program the indicator that colors the candles. You're going to have, the squeeze is probably available, but a few things you're going to have to program for use on a different platform. But NinjaTrader is what we use, and it's free. If you want to do it on a different platform, then it'll be up to you to. Now, some of these indicators are available on Futures.io. Futures.io is where a lot of these indicators are available. You can get the trigger lines on Futures.io. They may or may not already have a version available for Sierra charts. You got to pay for it on Futures.io. They may have a version available. But if you're working with me, I just hand these to you, and we use NinjaTrader. And keep in mind, you want to be using an end of day data. You don't, this analysis. So if you change platforms, your results in signals might be a little bit different with a different data provider.
Okay. And then just to make sure I understand, so there are different strategies, but every number and strategy is different also based on the different instrument, right?
Different strategies might have different settings of the indicators. Yes. So I might be doing a bullish strategy, but it'll be a different setting for these trigger lines. This might be a 10-period moving average on one. It might be a 15-period moving average on a different strategy.
Yes, and also for different instrument, 10 tick, 15 tick, those might be different.
For a different instrument, it might be a different stop value. Yes, it might be 10 tick entries. That's all in trading plan. The trading plan details all of that. So for everything we trade on the indices, it's the Dow, it's the YM, ES, NQ, and Russell 2000 RTY. And they will all have different entry values as far as buy stops or sell stops for the tick values. On the currencies, it'll either be 10 or 15 tick entries, buy stop 10 or 15. So it varies.
Thank you.
But that's all detailed, follow the plan. If you want to change something in the plan, then you have to do your research to see if your change will impact the net results positively or negatively. But once we do it, it's like, here are the results. If you follow these rules with these values, this is what to expect. If you choose to change it, that's okay. But do your homework to make sure that your change will have a positive impact, not a negative one. And Michael, does this work on SPY? This is for futures. This is for this particular strategies. We have different strategies specifically for the ETFs, which work extremely well. The ETF version for the strategies work on, they have a minimum 84% wins, and it's usually 84, 90-something% wins. That's with options. So with the SPY and all the ETFs, the sector ETF, that's options. And similar but different approach. I'm going to do that presentation in a couple of weeks. There's a video of one of the strategies online. Take a look at that. I'm not sure if I'll email it to you, but take a look at that one. But different strategies for the ETF options. Okay, we'll go over what happens when it hits NinjaTrader, and we use NinjaTrader still version 7. We have not switched to 8. Only reason we haven't switched to 8 yet is because I haven't spent the time to translate everything from version 7 to version 8. So we're still using version 7 until we have to switch to 8. So there's no big rush. Does this work on US 30 bonds? This works on the currency futures, and that's all we've spent any time on whatsoever, because we can trade them in smaller account. would they work on bonds? You have to do the back test. I've spent zero time looking at it on bonds, because we're focusing on the reality of being able to trade any size account. If you're going to swing trade on the bonds, then your stop loss is going to be a minimum of several $1,000s on one contract. That's the difference. These are futures, not stocks. For the Qs, that's an ETF. We use options for ETFs, or we buy shares. So for ETFs, that is the option strategy. This is the future strategy. These strategies are purely for futures. For the ETFs, we do options, or we buy shares. And the buying shares, I only show to people who are doing option trading with me, because that is a partner strategy with options. So yes, we have strategies that work on the Qs for the shares and also on the inverse ETFs, but that's on weekly charts, not daily, weekly charts only. And it's for buying shares off weekly charts only, not daily. We don't do this day-to-day buying shares, because to show that to people, they have to have huge accounts to be able to do anything meaningful. And because most people can't just go buy tens of thousands of dollars worth of shares of most of these ETFs and trade them, because we trade a group of ETFs. When you have 7, 8 trades valid, you need a huge account to do it, to get minimal return if you're just buying shares. That's why we trade with futures, because we have massive leverage. We can get a massive return with a little bit of capital. You were to trade the Qs to get the same result, you'd have to have an account several magnitudes higher than, at least 8, 9, 10 times more than the futures account. So that's the benefit of futures. We have leverage. So yes, we trade Qs with and all the different sectors, which I'll show you in a minute or two, or more. I'll show that a little bit later, with options only. And we do buy shares of ETFs only, but I only show that to people who are already doing options with me. I will not show shares, that strategy, to anyone who is not doing options with me, because options accompanies that particular strategy. All right. So this is for futures, not options. Okay. So let's take a look at this now. So we had this trade, and our entry price was 1.0913. The next day, it went as low as 1.0902. So that means within one day, the order filled. This is the day we had our trade signal. After the close, we place our order. This is the very next day. I'm now in the trade because the market went lower, filled my order on the sell stop. I'm now in this trade. Nothing for me to do. I'm going to get a notice, an email, or a text from my broker. Hey, your order filled. That's it. All right. So now, I might check once in a while. What's my target? 1.0823. The next day, the market went as low as 1.0891. So I'm in the trade for 2 days now. My first target's not hit. My stop loss is up here. That's obviously not hit. The next day, the market went as low as 1.0863. My target is 1.0823. So I'm in the trade 3 days now. My target's not hit yet. In the trade, life goes on. Next day, it goes up a little bit. Still in trade because my target's down here, 1.08. My target's right down here, 1.0823. Okay. Next day, it went down. The low that day, 1.0846. My target's still not hit yet. Okay, I'm in the trade now 1, 2, 3, 4, 5 days. But my target's not hit. Nothing for me to do. It's been 5 days, nothing for, and I'm going to look at it obviously once in a while, but there's nothing for me to do. I'm living my life. This is why we swing trade, especially with futures. Put the trade on, walk away. The next day you put your trade on, walk away with the next day's trade. Next day, put the trade on, walk away. Okay, go one more day. Low that day, 1.0833. Target's not hit yet. The target is 1.0823. 6 days, no big deal. Oh, obviously my target got hit this day. The low is 1.0781. Sometime this day, my target got hit. I'm now in this trade, short. If I chose to exit my whole position, then let's calculate the profit for that. So we calculated earlier that the risk per contract was $235 for each contract, and we got 4 contracts. What's 4 times 235? What's that number? 4 times 235. Type it in. $940. Okay. Our first target was 90 ticks from the entry price. On this day, my first target was hit. Okay, now let's calculate profit. We had 4 contracts. What is the profit on one contract? What is 90 ticks times $1.25? And then with $1.25, and so you did all the whole thing. So the total profit is $450. What's 940 divided by 450? No, 940 divided by 450. Michael, your numbers are, I think, inverted. So oh, no, you got it right. Excuse me. 450 divided by 940. 450 divided by 940 is what I meant to say. And we're going to calculate your percent return. So 450 divided by 940. 47%, Van, 0.47. That's the 47% return on your money. So you risked $940. That was your total risk on 4 contracts. If you took a full loss, it would have lost $940. You made $450 if you did nothing but get out of the first target. And that was a 47% return according to what Van calculated, assuming that's correct. So in 1, 2, 3, 4, 5, 6, 7 days, you made a 47% return on your money, doing nothing for all those days. Okay. If you're looking to make more, then what you would do is only sell 2 or 3 of your contracts at the first target and then trail your stop with a secondary target. Okay. So if you want to try to catch more, then you sell maybe 3 contracts or 2 contracts at the first target, move your stop down to protect some of your existing profits, and then see if you can catch more.
Do you do any break even, moving a stop loss to break even?
Past break even. You don't want to give back more than a certain amount of money, because it gets to a point where you're giving back too much. So if you have 4 contracts, you can sell 3 at the first target and trail your stop on the remaining contract. On that remaining contract, you already made a good bit of money on your first 3. That one, you can play with the stop, keep it loose, keep it tight, whatever you want, and try to catch a bigger move. On one contract, you can make more than you made with the other 3 combined, if you catch this bigger move down, depending on where you put the stop.
My question was that before reaching the target, we don't move a stop loss to break even.
Absolutely not, because that's called interfering with your trade. Everything is based on, given that stop loss you put in, the market goes up, down, You have to give the market, you don't know when the market's going to go back up and stop you out. Then you get nothing. So you don't arbitrarily, oh, I got to move my stop. It's not day trading. That's the type of thing you might do in day trading. This is not day trading. You have to allow the market to move. You have to trust the methodology you are trading. For this to work, the stop loss, leave the stop loss alone. The stop loss is meant to allow this market to go through all the swings and still be able to reach that first target 80% of the time prior to the stop loss being hit. So if you were given our initial stop loss and our initial target, we know that 8 out of 10 times the target will be reached before the stop loss is hit. So you leave your trade alone. It will either be a full loss or your first target will be reached. You leave your trade alone. And it works so well when you just sit back, leave it alone, but you have to trust the method. You don't just run to break even. Otherwise, the next, literally a minute later, it could retrace the other way and stop you out. So, but once the first target is hit, you move your stop loss down past break even. You might, depending on your personality, financial situation, how much time you have to dedicate each day. Some people who don't have the time or desire to look at positions each day and manage stops, take your 40, 50% return and go live your life. If you have more time and you have more flexibility and desire to manage positions, then go ahead, sell part of your position and manage the stops on the remaining. It all depends on also your financial reality. If you need the money now, then your stop loss or remaining contract will be a lot tighter, so you don't give back very much. But if you have money you don't need to right now to live on, then you can have a looser stop on those remaining contracts and give back some money. It's not a big deal. In the long run, having a looser stop, you'll catch more of the bigger moves. But it depends on your personal situation. So I work with people to determine what's right for you. If you really need that money or you have a small account, don't be giving back a bunch of money. You need to lock in that profit and keep it. Okay. It all depends on your personal situation, personality, family situation, so on and so forth. Everyone's different. So if someone, like when I see people trying to, well, this group's going to take the same trades together, that's a joke. You can't all take the same trades together. You all have different times you wake up every day, different work schedules, different trading sizes, different personalities, different account sizes. You can't all place the same trade. That's silly. That's why you see all these people failing when they go into trading rooms and thinking they're going to duplicate some trade that someone else is placing on a virtual account that's not even real. No, it doesn't work like that at all. This has to work for you when that fits into your life and your schedule and your personal situation. I've had people who I work with on options and they want to get up at the open at 6:30 a.m. Pacific time to trade. That's what they want to do. But because of their family situation, they're literally not allowed to, because it would disturb other family members who are sleeping. And they're not allowed to get up and trade. So their approach has to be completely different than other people who can be up at the open, because their personal situation does not allow them to do that. So everyone's situation is different. If you're working on the afternoons, and I try to get my trades in between 2 and 4 p.m. in most cases. Some people don't get home from work until 7 p.m. Their results might be a little bit different. And how they approach the trades, we might still be in that same trade that day, but they may have to enter the trade a little bit differently than how I enter the trade at 3 p.m. will be different than how they enter the trade at 8 or 9 p.m. And that's what I work with you on, to be able to do the same trade, but you have to approach it differently, see what the markets are doing, and then place your order. Your order type might be different. Where I'm placing a a sell stop, you might actually have to place a limit order depending on where the market is when you're placing the order, because you're coming in at a different time and the market isn't where it is when I place the order. So that's what I work with you on, to deal with those different scenarios. All right. So we went through a whole scenario on this. Trade setup, 2 lines crossed. Stop loss, entry, establish how many ticks are in between the stop loss and the entry price. We know the risk is $1.25 per tick, so you calculate what the dollar risk goes on one contract. If you want to risk $500, you get 2 contracts. If you want to risk $750, you get 3 contracts. So you trade size accordingly. You determine how many contracts you want to trade, and then you place your order. 1 triggers 2, so you place the order. Sell stop, X numbers of contracts. When that order fills, automatically it triggers the one cancels the other with your target and stop loss, and that's good till canceled. And if this order did not fill within 2 days, it has 2 days for it to fill. You make a note so that if the order is not filled in 2 days, you cancel the order, nothing, and it's done. You move on. So the order has to be filled within 2 days. And if you were to scroll back, you'll find this scenario happens all the time. Bearish cross, red candle, order fill within 2 days, down. Bearish cross, red candle. Bearish cross, green candle, no trade. Bearish cross, red candle, there's our trade. Bearish cross, red candle. Your order gets filled, goes against you for a couple of days, and then drops. Think about this. This is where your first target gets hit after you enter here on this big, massive down day when everyone's screaming, oh my goodness. You're having your money dance going on. This is awesome. This is what we live for, the days like this when there's a massive move in the market, especially downward, because the down moves happen really fast. And you just locked in your first target, and then it keeps dropping. So if you have more than 1 contract, you have multiple contracts on, this is a type of trade that doesn't pull back. It doesn't retrace and stop you out. It just keeps going and going and going, and you can not lock in. You might have been starting out, what's the range? You might have been starting out with maybe a 50 to 60 tick first target, but by the time you're done on the second contract, you're locking in several hundred ticks, okay, of profit. So your profit on 1 or 2 contracts will be more than your profit on 5 or 6 contracts at the first target, because you catch that bigger move. But these happen several times each year. You don't know when it's going to happen. Think about it. If it's happening here in Aussie, excuse me, in Euro, it might be happening in one of the other contracts also, and what might be Aussie or British pound or Swiss franc. So it's not just one trade. When these all go your way, they go your way. When they go against you, then your risk is limited to 2%. You take your losses when they happen. You can recover from a 2% loss. You can't recover from a 20, 30, 40% loss, okay? This is why we trade like this. When myself and Becky travel around, we had spent tens of thousands of dollars on education before we learned. We signed up with all these schools to learn to trade. 3 red candles, 3 green candles. Yes, do that. What they didn't tell you was about risk management. They didn't tell you about trade sizing. It wasn't until we started going to the Traders Expo in Las Vegas and going to other trainings in Orlando and Seattle, wherever we went to, Southern California, Oregon. We traveled literally all around the country, attend Salt Lake City. We went to all these places to learn to trade from people who trade their own real money. And the one commonality was the 2% account risk per trade, and they traded their own real money. It's a whole different experience from learning from just a school. People who trade their own real money is just different because they can give you real answers, not the theoretical ones. And so that is who we actually learned from, to really take our trading from being okay to being really profitable, okay? This is, let's see what time it is. This is an example of one of the strategies which we do. And all of our strategies kind of follow the same type of approach. The same type of approach is going to be Most strategy is going to be you're looking for 2 lines crossing, hooks, hook down or hook up. Like this line coming down and then increasing at the hook up. This line going up and then decreasing at the hook down. So most of our strategies involve either 2 lines crossing, that's the visual, the setup, or hookups or hook downs. Okay, and that's what we visually look for. And then after we see a hook, then we start looking for other trading opportunities. Assuming we start going through to verify it meets a certain criteria for that particular plan. But we have at least 10 strategies on the futures, maybe a little bit more, and we keep adding to that. But we trade them as a group, not just one strategy. If you trade this one strategy, sure, it'll work, but you're only going to have a couple of trades each year, because for this to have another trade signal, the market has to go down, 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 down. Several months go by, go up. We have another trade signal, but how many months? Because it has to go down, then up, and then down and goes up, 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 up again. Then another signal, and has to go down and up again. So you only get, the market only goes up and down so often over so many months. So it takes time for the market to go up and come back down. So there are only so many trade signals each year for each symbol. So this particular strategy is market tops. For this particular strategy, we have other ones for market bottoms, and for different strategies for the in-between. But this one is specifically for market tops. All right, so I want to show you a bigger picture of how money is made and lost, so you have a feel for it, trading the strategies. And I'll show you some of the good and the bad, because this year we've had some bad this year. What can I say? But if you're consistent, it's not too bad. If you're just random, it can be hit or miss. But I want to make sure you understand the good and the bad. So this is a spreadsheet I asked Becky to put together, showing the primary strategies which we trade for index futures and the currency futures over the last few years, and win-loss, and everything is based on having a 50 grand account. That could be a 25 grand account. That could be a 10 grand account. Okay, it doesn't matter how big the size, but I did it like this because I wanted to show risking 2%. So $1,000 risk per trade is representative of 2% of the account. We did 50 grand just to make these numbers easier so you can understand it. It'll never be exactly 1,000. It'll be above or below. So in reality, but this is give you a good understanding of how money is made or lost and approximate percentage returns to expect when you trade consistently. If you're just doing stuff randomly, your results will be random. If you're doing it in a business-like manner consistently, you can have expected annual returns and expected profits. All right, so let's take a look. January 2019. These were the strategies valid. You may have had more valid. We see 5 trades here which filled. You may have had 10 trades valid, but only 5 filled. Remember, with buy stops and sell stops, some trades don't actually fill, but you still have to account for those trades. But so they may or may not fill, but they're valid trades. Place the order, didn't fill in 2 days, cancel. These are the orders that filled. $180 profit, 0.4% return. Nothing special month. Then comes, remember, there's a 50 grand account. We're going to go through a whole year of trading, because you have to get through 6 to 12 months of trading a particular grouping of strategies to really understand how the numbers work. If you bail out after you see a couple of losses, it will not work for you. You have to stick it through and stick it out and trade, follow the plan, do what I tell you to do. At some point in time, you will be cussing me out, either directly or indirectly, just the way it is, because you're going to be like, "This, how can we lose all my money?" And I have to talk, and I will talk you down. That happens all the time. That's normal stuff. Becky doesn't get to see that part, but I've told her about it. But yeah, at some point in time, you're going to have losses. You're going to be second guessing me. You're going to second guess the strategies, but that's part of trading, is taking losses. So let's take a look how second month, February, 1740, 3.5% return. The next month, 3,000, 6% return. This is based on a 50 grand account. Next month, we had 3 trades, $1,500, 3%. Now think about this. If you were risking $2,000 per trade, this would be 1,700. This would be double this amount. If you're risking $2,000 per trade, you would have made $6,000. If you were risking $2,000 per trade, this would be $1,500. Okay, approximately. So start doing the
Sorry, I
numbers.
don't understand the January.
Yeah.
It should be a loss, not the $180 profit, because the profit is like 1,200 something, but the loss is 2,000, as I can see.
Yeah, this is the first target only. This is your 40 to 50% return at the first target.
Oh, you mean that the second target made more, so we can't see it here?
You can make more. We can't predict the second target, because second target is anything you can fantasize and make up and do whatever you want. I can tell you what will happen at the first target. If you decide you want to trade second targets and trail stops, then there are trades where you will give back money on the remaining contracts. So your percentage might be, you might end up with a 30% return on $300 because you gave back money on the remaining contracts. Or you might end up with $900 here instead of $420 because you made money on the remaining contracts. See what I mean? So all I can show you is first target. After
Yes,
the first target, you can do whatever you want after that.
My question is how that $180 is calculated.
Oh, net profit and loss. You had 3 wins at the first target and 2 full losses. This is profit. This whole column is profit at the first target.
Yes, but this 2 losses are way more than these 3 wins. But
that's correct. That's correct. You gave back money. You don't just win. You don't just make money trading.
But why we do see $180 profit then?
Because you made this much on one trade at the first target. You made this much on one trade at the first target. You made this much on one trade at the first target. You lost this much because it was a full loss. You lost this one because it was a full loss. The net is a plus 180.
Yeah, but I think he's saying when you do the math of what you see right there,
yeah,
for 24, 24, 20. I mean, excuse me, 464, 2400 minus 2,000, it comes up to a $780 loss and not a $180 profit on that one.
Okay, so month. Becky, did you get these numbers off? I gotta get Becky to. Oh, am I showing the whole thing? There. How about that?
There you go. That's what he was saying.
I was like, I know I went over these to make sure they were right. There were 2 lines missing. Is that better now?
Thank you.
I was like, oh yeah. I was like, I know after it was up, it's like, I know I looked at this earlier, and I think, okay, Becky puts all this stuff together. So, you know, I do not put anything into little rectangular boxes. I hate that. I do not spreadsheet. I hate putting stuff on spreadsheets. I do not like typing. I do not do this stuff. Becky is a database manager. She manages information, numbers, data, everything. So she's the one who creates all these spreadsheets, manages everything for us, maintains all the numbers for everything. So I was like, it's got to be right. Oh, but yeah, I just had to scroll up a little bit. So okay, so we had 1, 2, 3, 4, 5 wins and the 2 losses. That was a net result. So that's what. Okay, so that's it. Makes sense now?
Yes, thank you. And
okay, great. I was like,
2021.
What? Okay, good. All right, so next month, good month, good month. Okay. 1.5% plus 760. Once again, if you're risking $2,000 per trade, this is a low end of $1,500 something. If you're risking $2,000, this is $6,000. Okay, so we did a year of trading with wins and losses. You can't plan how much you're going to make each month. You can plan how much you're going to make annually. Like any other business, you're going to have some good months, some bad months, some profitable months, but you're consistently making money throughout. So we're looking always, you have to think big picture. So with a $50,000 account, we trade through December. And at the end of December, we end with a 40% return, $20,000. That's based on a 50 grand account. Okay. This is why I like this more than options, because I don't have to deal with time decay. I know how much I'm going to make exactly. I know how much I'm going to lose exactly. So some people don't like options because of all the variables. This is why futures is great. Everything is exact. And most of the trades last a few days to maybe 1 to 2 weeks. So you'll either make money quickly or lose money quickly, but you get your money back, you'll get your margin back to place that next trade. So optimal F, what's optimal F? Michael, what's optimal F? You're able to unmute and ask, answer that. What's optimal F? Okay, we'll come back. Okay, so anyway, that's a year's worth of trading. This is why you have to, you 2% of the account is 2% of the account. That's it. 2% of the account. So this whole exercise here is to show 2% account risk per trade. If you have a $100,000 account, your max risk, you should not be risking more than $2,000 on one trade, or else you can hurt your account. And you also have to factor in margin. Margin ties up capital. You can only place so many trades at one time. You might have multiple trades. You might have 7, 8, 9, 10 trades happening going on at the same time, literally the same time, plus new trades, which will tie up capital. So you have to think about margin. But 2% account risk is it. That is the magic number. No more than 2% account. So you cannot take a big loss. It's impossible. Impossible to take a big loss if your risk is just 2%. You can take a 2% account loss. That's it. So that is the magic number. And even if you think, oh, I want to do 3, 4%, that might sound good, but you're going to find that you're using up your margin really fast. And you're going to find yourself over margin. And that margin comes up big when you start placing a lot of trades. And if you're placing 1 or 2 trades, great. But if you're putting a lot of trades like we do, it's about 8 to 15 trades a month realistically. But you might have 8, 10 trades literally on at the same time, all tying up margin and risk capital. So you got to account for that in your account size. Okay, 2020. Good first month. This is our best month of trading in years. This is when the world shut us down, when everything was shut down, was shutting down. We had our best trading month, okay, a 13% return, because we just caught all the trade signals long and short, okay? First part of the month long, second part of the month short. So this added up really, really, really nicely that month, when the world was shutting down. My 2020 and 2021 were probably my best years of futures trading ever. Just super profitable. Then the next month, another great month. This was also one of those months where everything was shut down. Because remember, the market just got crushed. And then we had a massive rally back up. So the market got crushed and then it got rallied back up, and we caught them both. Second best month. These 2 months when the market just got destroyed, it dropped, I don't know how much, but then but we caught all those trade signals. And this is the benefit of trading the micro futures. If you were trading these with the full size contracts, you would need a $300,000 to $500,000 account to be able to place these trades. But since we have trading with micros, we can have a much smaller account and be able to capitalize on all these trades as they came up. That's the benefit of having the micro contracts available to us, to be able to trade all these. You won't be in every single trade, but if you can be, do it. If you can afford it, take every single trade. That's how you get the best result, by taking every single trade. All right, going on. Good results, good trading. Now, take a look at this. If you would have started trading with me this month, you would have been like, this sucks. This program sucks. This guy sucks. He just lost all my money. I've lost thousands of dollars and only made a couple, because you might place your first 5 trades and you lose all your money in your first 5 trades and you're discouraged. You say, this system isn't working. Let's say we had this meetup on the last day of May, and then people wanted to sign up for coaching the next day, and they're like, great, and we do all this, we prepping, you learn all the strategies, then you start placing trades at the beginning of June, and all you see are losses, and losses. It happens. That could be you starting. If you started earlier in the year, it's no big deal, you gave back some money. But if you started here and then all you saw were losses, you'd be discouraged. You'd be like, this system doesn't work. That is why you have to commit to trading for 6 to 12 months on any particular strategy, at least 3 to 6 minimum. Supposed to bound place per trade to avoid risk of you don't trade in a vacuum. All right, so that is what we have to do, is get through losses, and that's the hardest part. This is what things look like in February of this year and June of this year. And we even had some extra losses in June of this year. So June of this year, we were down like 6-point-something% in 1 month. And then it was offset by other wins. But so this is what June looked like this year. And this is what February looked like this year. So we had 2 months like this. You keep trading. We had this awesome January of trading and gave back money in February. March was break even. May was up and down. June was a loss. So we made money, gave back money, made money, gave back money, and we kind of flattish right now because we had a few more wins and other trades in progress. So we keep trading. You sucky month, but here's, like I said, here's where people start cussing me out, and I have to explain to them about, you know, expected losses, go back to there. It's just normal expected. At some point in time, you will guaranteed beyond any shadow of a doubt to have 3 to 5 losses in a row. It will happen, guaranteed, no question about it. That's why the 2% is really important. You cannot take big losses. And as long as you're consistent, your wins offset your losses. You're down 4.5% for the month, big deal. Keep trading, good month, profitable month. Good month. September and October usually pretty okay. This month we had a slight negative, 1.something% down. As long as you keep booking profit, remember this is first target only, and it's 40 to 50% return on each first target on every trade. So as long as you keep booking profits to offset the losses, you gotta keep trading, no matter what. You gotta trust the methodology and keep trading. When the year is over, it's a 51% return for the year, just doing first target only, taking all trades. All right. An awesome November, no trades valid in December that year. And you finish with a 51% return. This is why I wanted to show you this big picture, because you gotta trade the big picture, not what's right in front of your face. I'm getting all these losses right now. That'll happen. It will happen. And you have to place the next trade, place the next trade, place the next trade. And you keep, and with myself and Beck, we've gone through this so many times in the past where, you know, we would be taking losses and then we look back and then we review all of our losses. And as long as you keep trading your method, it works out just perfectly, because losses are followed by wins. In our mind, we'll be thinking, we're never going to see another win again. That's not the case. Losses are followed by wins. A lot of wins, because it's 80-something% wins. So you just have to keep trading through the losses, because you don't know when the losses will come. Once again, another great January, just like this year, we had another great January and a great February. Awesome February. So now you're in a plus, keep going through 2021. And you're ending December was a losing month, down 4% for the month, and with a 62% return for the year. So this spreadsheet shows annual returns. If you're placing all the trades, the first target only. This gives you a feel for the approximate what you should be expecting % return on your account. So far for this year, I know, like I said, we've had a big winning January, losing February, winning March, break even 1 month, and definitely losing June. So we down maybe 6-7% for the year so far for the futures for this year. That I know. Okay, and you just got to keep trading through it because it's down. It's basically you are 5 or 6 trades away from being profitable, and we have several trades in progress right now. We'll be net profitable probably in the next week or two because we got a lot of buy signals. We've had buy signals for the last couple of weeks now, and those trades are all in progress. All right, so we went through a lot of stuff. Do we have any questions on anything on the charts, profitability? I'm going to switch back to the chart real quick, or the trading plan. I'm going to share that again.
Just a quick question with
Yeah.
this brokerage that you trade, how much is the margin required for the intraday?
Okay, this is not day trading. So this is swing trading. You're going to be paying on the euro. It's $317 is the margin.
Sorry, the voice
It's
is
not day
getting very
trading.
low. How much? Could you please repeat?
For 1 euro contract, it's $317. This is not day trading, so it's not intraday. This is the margin. So for the euro micro, it's $317 for the euro. And which brokerage are you using right now?
I'm using a stage 5, also using Thinkorswim.
Okay,
TD
you have to
Ameritrade.
check with them for what their rates are, or what their margin is. And also fees. Like I found out talking to some people, because they show me what their trades are, them reviewing their trades for them. I have people paying twice the commissions I'm paying, literally twice the commissions. So I have a question from Michael. Do you use the 200 moving average as a filter? That is stock swing trading stuff, has nothing to do with these strategies. If you don't see it in the chart, it has nothing to do with the strategy. If you don't see it in the trading plan, it has nothing to do with the strategy. So the 200 MA might be a filter for something long-term on a stock chart, but there's nothing to do with this strategy. And also 200 MA would have nothing to do with any of our strategies on stocks, options, futures, commodities, or anything else. That's just a general thing that's not part of any strategy which we trade. We used that way back when we were just starting trading. It took you, well, you got the 50 and the 200 and this, and we don't do that stuff anymore. We're way past that. So we make money. 200 would have no impact on anything we're doing on over 2 or 3 days worth of time, because all these trades take 2, 3, 4, 5 days. So 200 MA would be too big a time frame for anything meaningful to us. You got to use a smaller period to do analysis when we're looking for trades that only take a couple of days. So, but yeah, we used to use that when we were doing bigger option moves or bigger stock moves, and we'd have the 200 stacked up on 100 and the 50, and we'd do all that stuff, and it was cool, it worked, but different type of trading. And also, you can also get a 200 by doing a weekly chart and being creative by using a 40-period moving average, and on a weekly chart is kind of like having a 200-day. So we did creative stuff like that with different time frames also to emulate a 200, but mostly weekly charts. Okay, any questions so far on any of this stuff? Like I said, the approach, this is one approach we use for swing trading on bearish charts for bearish trades. It's one of our favorite ones because we've had it for so long. We did Forex with the same strategy, and then we switched it over to futures for basically, it's currency futures and Forex is basically the same thing. We're just doing it on futures. We rather trade futures than Forex for the currencies. There's more protection, so on and so forth. So I'm going to switch back here to handout. So if anyone is interested in working with me on these strategies, we have 2 futures programs. One is just for the futures and one is futures and options. So we have at least 10 different strategies, and there's going to be more, and we keep adding. And it's for the indices, it's the ES, NQ, RTY, and YM, the Dow. And we also can trade the micro futures with those. So that makes it real easy to trade. You don't have to have a massive monster account to be able to trade them. And for the currencies, is the Aussie dollar, Canadian dollar, euros, Swiss franc, and British pound also. So those are and I always put in writing to allow 6 months to get your trading consistent. If you start a month and then you looks really good and you have a couple of losses, you get discouraged. You need at least 6 months to see the numbers work out. 6 months of doing the trading the way I show you to trade it, to really trust the methodology, to see the numbers work out. If you happen to be one of those people who starts out on those months where we have the losses, and it's gonna suck for you. That's the way it is. It's gonna suck a little bit. You have to get through it, and you get through it by controlling your losses, no more than 2% account risk. And you see the numbers work yourself out, and then it goes really well. And I will email the valid trades each day for the first couple of months. And then after that, if you want to continue having the emails sent to you each day with the trades, then there's an extra cost for that. But when we're starting out for the first three months or so, I will send you all the trade signals each day so that you can compare what we're finding to what you're finding. And that helps you get going, to get your confidence to be able to see the signals. But I work one-on-one with people only, no big group things. Everything's individualized to your schedule. So if you're available evenings, we set up schedule to work with you on evenings. If it's available in mornings, I set up times on mornings. If it's afternoons, I set up times on afternoons. And Sundays, I don't do stuff on Saturdays usually. That's when I go to my jiu-jitsu class. I train in Brazilian jiu-jitsu every Saturday and do other things, stunt training on Saturdays. So Saturdays, it's my time. Movies on Saturday. But during the week is when I allocate time in evenings, afternoons. I have a really flexible schedule. That was the benefit of leaving my full-time job as an engineer, to be able to trade for a living, is that I have a lot of free time and flexibility in schedule. So yesterday I spent 5 hours on stunt weapons training. My stunt group, we actually were training on fighting with knives, fighting with swords, fighting with guns, and then doing falls and flips and fights and crashing through things. And yes, there's all kind of fun stuff that's available in the Bay Area, stunt training. And I've been working on films for 20 something years now, and I still have fun doing it. I still throw my body around and enjoy it. And hopefully in the next year or so, I'll get my black belt in Brazilian Jiu-Jitsu sometime next year. So yes, every week I choke people out, and people come and big dudes try to choke me out, twist my arms around, and I have a blast doing it. Love martial arts. I've been a martial artist for decades, and I really, really enjoy it. But trading gives me the time to train, to teach. I'm involved in city government. Once again, time. I have time to do all this stuff because of trading. If it wasn't for trading, I would have never left my full-time job, and that created so many more opportunities for me. So, but like I said, this is for the futures coaching. It takes about as many hours as you need is what I'll spend with you. This is futures and options program. This futures, $17.45 is the cost. If you're on the meetup right now, it's $16.45. I'll take $100 off. Just let me know before this week is over. If you want to do both futures and options, it's $34.95 and take $500 off this price. If you let me know by the end of this week, I will take $500 off to do options and futures. There are a couple of videos to show how we approach long trades on futures and also some trades on options. That is also on the website. You can take a look for those and download those. They're on the email I sent you also. So, but that'll give you a feel. But yeah, and I will meet with you in person or on Zoom, whichever one you prefer. I'm in the South Bay in Santa Clara. If you can meet with me in person, perfect. If you want to do Zoom, perfect. But the first thing we do is get your computer set up with your charts. That's first and foremost, so that your charts and my charts look alike. Otherwise, you'll get varying results. All right, so before we sign off, do we have any questions on anything whatsoever? Anything at all? I think I gave you a good feel for how we approach our strategies. Like I said, all of our strategies involve a cross, a hook up or hook down. And then once we get that setup visual, then we can go into more detail to check all the bullets to make sure the trigger is correct and everything. But I gave you a good feel for the trade management we use, which is we use that same trade management on probably 70% of our future strategies. That's the approach where we look for 40 to 50% return at the first target. But you got a good feel for how we make money, the big picture. Do you have any questions? Anything at all? Okay. Okay, if we don't have any questions, I'm going to go ahead and wrap it up. We will have our next meetup on July 31st. That's Sunday. That's going to be an option. It's going to be one of the Ichimoku strategies, one of the ones we've had around for a long time. And that's something you can use pretty immediately. That's going to be an option strategy. And if you have an interest in futures coaching, just call me, email me, and I'll talk to you. Make sure we're on the right page. You have expectations which are realistic. Or make sure you have realistic expectations. If you plan on doubling, tripling your money every year, not realistic. And we're not gambling. The profits look like on that spreadsheet we went through. That's realistic. All right. So I want to make sure you have realistic expectations. All right. Then I'm going to log off and see you guys and ladies in 3 weeks on the 31st. All right. Yeah. Y'all have a good day.